Welcome to the 1% Playbook. So today I'm going to go ahead and just dive into lesson one. We're going to talk about what Forex is and how we're going to make money in the markets, how you're going to make money in the markets. Once you get the hang of it, you see everything in the charts, you know how to mark your charts, where all your areas of interest go, where to put your take profits, your stop losses, and give yourself the highest probability to win your trades. As long as you don't give up, you cannot lose ever. So, as long as you guys keep going, you will be profitable. So, today we're going to dive right into what Forex is. So, what Forex is you're basically trading currency for currency. So, if you've ever been to another country, you exchange US dollars for British pound, or for example, US dollar for I was in Brazil for 2 years, so the Brazilian real. So all these different currency pairs and the price difference between each one. So they go up and they go down just depending on which currency is strengthening and which currency is weakening. So for example, here we've got the Great British Pound, the New Zealand dollar. So for example, if we scroll over here, price had a movement to the upside. This is on the 1 hour. Let's go into a little more stronger. The higher the time frame, the stronger confluence will be. So daily right here. So started right here. The British pound was strengthening, and over here, as you see this big drop off, the Great British Pound was weakening the New Zealand dollar. So when this chart, GBP NZD, Great British Pound to the New Zealand dollar, is going down, that means the New Zealand dollar is strengthening over the Great British Pound. And the Great British Pound is weakening against the New Zealand dollar. So all of these different currency pairs, you have USD CHF, you've got Euro CHF, Euro GBP, CAD JPY, Euro NZD. I do trade gold sometimes. That's XAU USD. Gold in a while, but we did catch some good gold buys down here. Made some profits down there, but haven't traded it since then. That was back in last year. So I don't trade gold too much unless I see a really good setup, one that I feel confident in putting thousands of dollars behind. But all of these different, you have AUD USD, GBP USD, CHF JPY, USD CAD, Euro AUD. So go through and you can take all the ones that I personally trade because they are the most volatile. They give me the greatest moves flowing through these markets. And actually, Forex as a whole has trillions of dollars flowing through it every single day. So, a few million, right? So, yeah, you guys can go ahead and you guys can shot. If you want to plug them into your trading view. So, trading view is where I do all of my analysis. I go and micro up my charts, put my areas of interest, decide where the trade to these, it's bullish going up or bearish going down. That's pretty much what I use TradingView for. I don't use it to trade. I have a broker that is connected to my MetaTrader 5 account, which we'll go over in another lesson. So that's what I use TradingView for. I use it to mark up my charts, to decide which currency pair is either bearish or bullish in the overall time frame, and then I'll trade with the trend that week. So during our war meetings, I go over all the pairs that I'm interested in, and you guys copy me. I encourage you guys to do your own technical analysis every single week, so that you guys can actually learn these things. You can copy me, but what good is that doing for you? So through, and you can screen currency pairs here, is predicting whether the market's going to go up or whether the market's going to go down. So for example here, let me find a Monday. I did not enter this trade. I actually entered another one, but this one right here, we anticipated for the market to go down. Of course, it broke. We actually had an entry up, didn't Wasn't able to get in, but that's okay. You just move on to the next one if you miss your entry. Had another entry here, could have entered. I was about to, but I entered another trade instead. But they're both going direction. So here's the trade that I entered. Entered this around 2 a.m. this morning. And yeah, so we're almost, look at that. Look at it, almost off it. But anyway, we're going to continue to hold this trade until we hit. So I think we're up of like 5,000 right now. Our take profits at around 7,500. So for the market to go down, you profit, you make money. If you're anticipating for it to go up and it goes up, you make money. So you always want to trade with the trend. The trend is, you hear that a lot. And the trend is going to help you to decide whether you want to buy or to sell. So I want to go into a little bit of terminology. So let's say I am putting in a sell order, right? So we go over here, put our short position. So when you short the market, you sell the market, which all that's meaning is you're anticipating for the market to go down. So if we put sell order, set a take profit, and stop. So put it up these wicks here. I always make sure I get a 1 to 2 risk to reward minimum, meaning whatever I'm risking, make double. So if I'm risking 3,000, I want to make 6,000 on the trade. 6,000 profit. So as you little 71.9, and you'll see down here 143.6. Now, what that is made up of small market movements, and all these are called pips. I'm gonna put pips. Measure take. I can move this up, move it bigger. We've got 90.8 pips. If I move this down more, we've got this sitting at 157.6 pips. So it's just a small market movement is what a pip is. I want to go over leverage a little bit. So what leverage is, leverage, borrowed with. So lose, the more money you can make, but also the more money you can lose. So you always want to risk what you're okay with losing. You'll see that some brokers use a 1 to 50 leverage. And Forex.com, they all use a 1 to 50 leverage. I know some of them use a 1 to 100 leverage, 100. I personally like using a 1 to 100, 1 to 500. Just allows me to trade with a lot more of my capital. So I'll put the broker IX trade LQH. I like the leverage that 1x trade and LQH. So they both provide a 1 to 500. So a lot in the markets, because they don't know how to manage leverage. And I want to make this clear, just never risk more than you are comfortable with risking. I have a big account, so I'm okay with risking thousands and thousands of dollars on a single trade. But when I was first out, I had, I had $50 in a trading account. I lost every single bit of it, and I was actually losing continually for a little bit until I started making money and I started figuring out how to manage my risk and actually mark up my charts. So to save you guys a lot of time and money, I would try paper trading, just trading with just pretend demo money with a demo account and seeing how that rates. See you get better and better and better at reading and predicting where the price is going to go, either up or down. If I could give you any advice, it would be to do that, because I wasted a lot of money. Now I will say was a little more cautious because it was my own capital that I was risking. Like, it put me in the game, but I lost a lot of money to begin with, just trying to figure out trading, figure out how this works, to figure out how the market moves. And I could have avoided a lot of that if I had not traded with my own capital. Or, if you want to be feeling like, okay, this is my money, I can make money, it puts you in a different mindset, actual money. And I would suggest, putting in $100 and only risking a small amount of that account down until you start winning continuously. And, then you can put more money in, but always, I'm going to put there, always, and be okay with the market is very unpredictable. Big news events, economic events can pop up out of nowhere and take you out, or it can go in your favor, take you straight to take profit, but you never want to risk more than you're okay with losing. Market. So a lot of market movements come from the big guys, which are your hedge funds, your big institution. They are the one, your banks, they're the one billions of dollars into this market every day, which make these big price movements going up and down. And our goal is to catch what they're doing. So drop in the market, sending the market down, we want to get in on those sells. We want to short. And the same thing with buys. So us retail traders, we don't have that much of an on whether the market goes up or the market goes down. These big banks, institutions, hedge funds, they are all buying and selling. You've got these buyers and sellers fighting back and forth. Come right here, you see where you've got these blue candles right here. So we had buyers winning the market. And I had this, this boom, big, huge news, and sellers just absolutely took over the market. And news will do that. So in this instance, we had the break. We could have gotten in on the retest to then continue sells and be in profit. So us traders, you and me, we like 5%, I think, or not even 5% of through the market. So what we want to catch these small market moves. So in reality, these are small moves. So if I'm trying to catch this right here weekly, all I was catching was it. If we zoom out, it is very big, and it has been going on for years and years and years and decades. So economies change. As traders, to adapt to put right here is yes, buyers. Hedge fund. So to kind of, we buy and sell. What I mean by, for example, sell above this area over later. Areas of interest are just where price in the past. So if we're above an area of interest, we want to buy. So this would be considered a low, and we want to buy from here to catch this profit right here. If we're below this area of interest, we want to sell. So we want to sell from this point right here. We're now anticipating for the market to go down. So we want to buy low when the price is low, so we catch well when it's high, so that we catch the biggest move possible for sales. So pretty much that's it. That's pretty much the base. That's who moves, which are buyers and sellers. We got our buyers in the blue, we got our sellers in the red. We've got our pips, which are the small market movements, our stop losses and our take profits. We've got leverage, which is our borrowed money, so that we can trade with bigger positions. I personally use 1x Trade and LQH markets so that I can use the most leverage that I need in order to put in the positions. For me, you want to be cautious and risk what you are okay with losing. So currency pairs, GBP to the New Zealand dollar, and that is what we are and predicting to buy the market. Another word for shorting the market. Retail traders make predicting which way the market is moving. It's a bunch. Trade the trend. So if the overall is going up, I want to sell. See, the trend is going down. We've got this lower high, lower low, lower high, lower low. Well, not quite. Lower high, lower low. Market structure. We'll go over market structure. But the overall trend is bearish. It's going down, so we want to sell. And that's what's happening here. We got this little pullback here. And we caught this in sales. Well, we didn't catch it. We didn't enter it. But that's how the market moves, and that's how we make money as retail traders. We're just predicting the moves of the big guys who are putting in and pumping the market with billions of dollars. So that's how we profit. So you guys can screenshot this here, and that's of what Forex is. Now we are going to start going to marking up our charts, areas of interest, entry signals, when to get into it, where to put our stop losses, where to put our take profit, and how we are going to profit on these market movements. We're going to start getting into the nitty-gritty of how we are going to make a profit. Make a profit by our tests. You've got our fundamental analysis and our technical analysis. Your fundamental analysis will follow suit of your technical analysis. Fundamentals is news. Technicals is your charts, your candlesticks. So go ahead, screenshot this, but I will see you guys in lesson